A CVA is a Company Voluntary Arrangement, or CVA for short, often known as a CVA. It's been around for about 25 years, and it's a formal legal process that allows a company which is viable but has financial problems to restructure their financial issues and effectively start again. Not quite debt-free, but writing off quite a lot of that debt. The premise of the CVA is, can we offer to pay back X pence in the pound over Y period of time? There isn't a prescriptive format for what the CVA should offer, but the process must be set out under the guidance of the law, and you will need an insolvency practitioner to act for you. Essentially, what you'll be doing is preparing a proposal. That proposal has three parts. The first part is a financial forecast to show where the business is going. The second part is a statement of affairs to show what has happened and what the assets and liabilities are worth and what they might fetch if a CVA was not agreed. The third part is essentially a story or a narrative to set out the deal to the creditors. Once that's done, the insolvency practitioner takes it to the court and then sends a copy of the proposal to all of the creditors. It's not as scary as it seems. However, a creditors meeting must be held and the director must be present at the creditors meeting. It's also important to remember that the creditors are there to try and get a better deal. You're trying to propose a deal. At the end of the day, if everybody gets a deal, it's got to be in the best interest of the creditors. You need to get 3/4 of those creditors who vote to actually vote in favour of the CVA for it to be approved. Thereafter, the proposal sets out what happens. It's important to note that a CVA is a good deal for creditors as they retain a customer and may receive some of their debts back over time. VAT and PAYE must be paid back 100 pence in the pound first in the CVA over years 1 to 4 or 1 to 5, before all other unsecured creditors. Then trade and suppliers will usually receive between 5p and 100p in the pound of their debts, depending on what your company can afford to pay back. So essentially, it's paying a set amount back each month into a scheme for an agreed period of time. Once that first year has elapsed, the supervisor of the arrangement, who has no power over the company, will distribute money to the creditors. And that's it in a nutshell. What you need to remember is very powerful for reorganising the business. We can take out the cost, we can make people redundant and the government picks up the cost of those redundancies. We can close factories or shops or warehouses, we can terminate leases we have with our landlords. So if you're thinking about how to make the business viable, think carefully about a CVA. It's not for every business, but it is the most powerful insolvency tool in the UK and the most flexible tool also. But before we finish, what's in it for the directors and shareholders? Well, essentially, the directors remain in control of their business. The shareholders can still have a stake in the business, but they can't have any dividends. And what about for the creditors? Well, they get something back that they wouldn't ordinarily get back if it was a liquidation or an administration. So there you have it. If you want to know more about CVAs, please read the free 92-page guide on our website, companyrescue.co.uk. It can be downloaded for free ease of use. And if you need further information, please give us a call on our free phone.